Good morning, traders. If you're staring at your screen right now, watching silver hover near $99, you might think you're witnessing the peak. You might think this is as good as it gets. But I'm here to tell you something that will fundamentally change how you view this market. What you're seeing isn't the destination. It's barely the starting line. While American traders are fixated on the psychological barrier of $100, something extraordinary is happening halfway around the world that Wall Street doesn't want you to know about. And when you understand what I'm about to show you, you'll realize that $90 silver isn't expensive, it's on clearance. Let me hit you with a number that should make every trader in America sit up straight, $130 per ounce. That's not a typo. That's not speculation. That's the current trading price for silver on the Shanghai Futures Exchange right now, today, as I'm recording this. Think about what that means. While we're celebrating $99 in New York, the largest manufacturing economy on Earth is paying $113 for the exact same metal. That's a 14 spread, a 14% gap between East and West on a commodity that can be shipped anywhere in the world within 48 hours. In finance, when you see a price discrepancy like this, it's called arbitrage. And a 14 arbitrage on a 1990 asset isn't just unusual. It's screaming that something is fundamentally broken in the pricing mechanism. Here's the simple physics of it. If I can buy silver in New York for $99 and sell it in Shanghai for $113, I just made $14 per ounce by simply moving the metal across an ocean. That's a 14% return for logistics. Hedge funds would kill for that kind of risk-free profit. And that's exactly what's happening right now. America has become the discount warehouse for the world's silver supply. Now, I could tell you that arbitrage traders are exploiting this price gap, but why speculate when we have the receipts? The CME Group publishes daily warehouse reports that show exactly how much silver is moving in and out of approved depositories. Usually, these reports are boring. A few thousand ounces here, a few thousand there. Background noise. But yesterday's report wasn't noise. It was an alarm bell. In a single 24-hour period, 4.2 million ounces of silver were physically withdrawn from COMEX vaults. Let me give you some perspective on that number. 4.2 million ounces is roughly 130 metric tons. That's not retail investors buying coins for their safe deposit boxes. That's industrial-scale extraction. That's armored trucks lined up at loading docks. That's a 747 cargo plane being loaded to maximum capacity. This is a bank run. Not on cash, but on metal. And when you look at which vaults are bleeding, the story gets even more concerning. 1.2 million ounces withdrawn from CNT, 600,000 ounces withdrawn from Asahi, 1.6 million ounces withdrawn from Brinks. JP Morgan is the fortress. They hold the largest silver inventory in the Western Hemisphere. For years, the market assumed JPM was the backstop. If things got tight, they'd lease metal into the market to stabilize prices. Well, the fortress just got raided. When you see over 1 million ounces leave JP Morgan's vault in one day, it tells you the smart money isn't comfortable leaving their assets in the banking system anymore. They're taking physical possession. They're moving from financial storage to strategic storage. Why? Because of that $113 Shanghai price. If you own silver sitting in a New York vault and you can sell it locally for $99 or ship it to China for $130, the math is simple. You withdraw the metal, put it on a plane, and pocket an extra $14 per ounce. Multiply that by 1 million ounces, and you just made $14 million for the cost of international shipping. This is why the vaults are hemorrhaging. But here's where it gets truly dangerous. In the COMEX system, there are two categories of silver: eligible silver, which is just sitting in storage with no obligation attached, and registered silver, which is available for delivery against futures contracts. Registered silver is what actually backs the paper market. It's the only metal that matters for price discovery. And yesterday, registered inventory collapsed by 1.7 million ounces, falling to just 114 million ounces total. Now, 114 million ounces sounds like a lot, right? At $100 per ounce, that's $11.4 billion worth of silver backing the entire global COMEX futures market. $11 billion, that's nothing in the context of global finance. Elon Musk has lost more than that in a single day on Tesla stock swings. The entire registered silver inventory backing the world's most important precious metals exchange is worth less than a mid-sized tech acquisition. and it's draining at a rate of 4 million ounces per day. Do that math forward. If this pace continues, we're looking at less than 30 days before we hit critical levels where the exchange physically cannot deliver on all outstanding contracts. Here's the leverage problem. Every COMEX futures contract represents 5,000 ounces of silver. The total open interest, all the contracts outstanding, represents hundreds of millions of ounces in paper claims. But there's only 114 million ounces of registered physical silver to back it up. The ratio of paper to physical is exploding, and as long as everyone's content to trade paper, the game continues. But that 4.2 million ounce withdrawal proves that major players are no longer content with paper. They want the metal. And there aren't enough chairs when the music stops. Here's where weekend risk comes into play and why today, Friday, is absolutely critical. In normal markets, traders like to go home flat for the weekend. They close positions. They take risk off the table. They don't want to worry about what happens when markets are closed and they can't react. But this isn't a normal market. In a breakout market like this, the risk calculation flips completely upside down. Imagine you're a hedge fund manager, short silver. You're betting the price goes down. You see silver at 99. You see Shanghai at 113. You see 4.2 million ounces draining from vaults in a single day. And you know that over the weekend, while the COMEX is closed, anything could happen. China could announce new export restrictions. The US Mint could announce extended closures. A Middle Eastern sovereign wealth fund could announce a $1 billion purchase. A major mine could have an accident. If any of that happens while you're short, you don't just lose money, you get obliterated. Because when the market reopens Sunday night, it doesn't open at $99. It gaps to 110, 150s, maybe higher, and your stop loss doesn't matter because there's nothing to stop. The price just skipped right over it. Nobody wants to be short silver going into the weekend when Shanghai is trading at 113s. So what happens today? Short covering. Traders who are short will panic buy to close their positions before the weekend. They need to sleep. They can't afford to wake up Sunday night to disaster. This fear of the gap is a powerful price driver. It pushes prices higher even without new fundamental news. Let's talk about what $100 means psychologically. When an asset moves from 99s to $100, it doesn't just cross a number. It crosses a threshold in people's minds. At 99s, silver is still a volatile commodity, something you trade for profit. At $100, silver transforms into something else entirely. It becomes a store of value. It gets the attention of pension funds, family offices, and institutional money managers who wouldn't look twice at a two-digit commodity. Unit bias kicks in. People stop seeing it as expensive and start seeing it as valuable. But here's the trap most investors fall into. They're buying paper at 99, thinking they're getting a bargain. They didn't realize that paper contract is a claim on a vault that's bleeding 4 million ounces a day. They're entering a casino where the house is running out of chips. And here's what the bears get wrong. They said silver was in surplus. They said industrial demand would collapse in a recession. They said high interest rates would crush precious metals. 1990s proves all of them wrong. It proves the deficit is real. It proves industrial demand is inelastic. Manufacturers need silver for solar panels, electronics, and EVs regardless of price. And it proves that when confidence in currency itself is questioned, interest rates don't matter. Now, let's talk about where this is headed, because $100 is not the ceiling. It's a way station. There's an economic concept called a Veblen good, a rare phenomenon where demand actually increases as price rises. Think Rolex watches, Ferraris, or Bitcoin. People don't buy them because they're cheap. They buy them because they're expensive. The high price signals value, status, and desirability. When silver crosses $100, it stops being a cheap industrial metal in the public mind. It becomes a precious monetary asset. The price itself becomes marketing. It screams to the world, this is valuable. This is real money. The fear of missing out kicks in at triple digits. Retail investors who've been sitting on the sidelines will see the headlines and panic. I missed it. I need to get in before it hits $150, $200. This creates a buying frenzy. And remember, this demand surge hits a market with essentially zero available supply. The mint is rationing. Dealers have waiting lists. Vaults are empty. Vertical demand meets zero supply. That's the recipe for a melt-up. So, where does this end? What's the actual ceiling? To find the answer, look at gold. Gold is approaching $5,000 per ounce. Throughout history, the natural ratio of gold to silver has averaged around 15 to 1. If we apply that historical ratio today, $4,150 divided by 15 equals 330 per ounce. By that measure, 99 silver is expensive. It's trading at a 70% discount to its historical relationship with gold. It's one of the most undervalued assets in the entire financial system. This is why the banks are terrified. They know this math. They know if the market mean reverts to historical norms, their massive short positions will be completely vaporized. So, what should you do as we enter the triple-digit era? First, understand what you're actually holding. When you take profits by selling silver, ask yourself, what are you winning? You're exchanging a scarce physical asset for fiat currency being printed by the trillions to bail out failing banks and government bond markets. You're trading something they can't make more of for something they're creating out of thin air. Second, think in terms of asset rotation, not just cash. Some of the smartest investors don't sell silver for dollars. They wait to exchange metal for income-producing assets when the mania peaks. They watch the silver to real estate ratio, waiting for the moment when silver is so overvalued they can trade a stack of coins for a rental property. Third, manage volatility without abandoning the trend. Yes, there will be pullbacks. There will be days when silver drops $5 or $10. That's noise. The trend, the structural shortage, the currency debasement, the industrial demand, that's the signal. Don't confuse temporary volatility with a change in the fundamental story. Here's what's happening in plain English. The global pricing mechanism for silver is broken. The West has artificially suppressed prices for decades, while the East has been quietly accumulating physical metal. That game is ending. The $14 spread between New York and Shanghai is the market screaming that Western prices are wrong. Physical silver is flowing from west to east at an accelerating rate because arbitrage demands it. American vaults are being drained of 4+ million ounces per day. The registered inventory backing the paper market is collapsing, and short sellers are trapped between a gamma squeeze, arbitrage buyers, and the weekend risk of catastrophic news. 90 $90 isn't the top. It's the bottom of a new range. With Shanghai at 130 $, the $99 New York price represents deep value, a 12% discount to the global physical market. As arbitrage forces the prices to converge, and as the psychological barrier of $100 breaks, we're entering a new phase of price discovery. The banks can fight for a few more hours. They can try to defend $100 with sell walls and technical manipulation. But they can't fight the physics of global capital flows. Money flows to value. And right now, the world is telling us that silver is worth 130 $. The train is leaving the station. The question isn't whether silver hits triple digits, it's whether you'll still be holding when it does. This is the wealth transfer moment. From those who trust paper to those who trust metal. From those who believe in central bank promises to those who believe in physical reality. The era of cheap silver is over. Welcome to the triple-digit age. If you found this analysis valuable, hit subscribe and share this with someone who needs to understand what's really happening in the silver market. The mainstream media won't tell you this story. They're too busy protecting the very institutions that are on the wrong side of this trade. Stay informed, stay ahead, and most importantly, stay positioned.